In this video we are going to be analysing Twilio, ticker TWLO. Now we have just had the earnings. This is what made the stock sink from $65 at the market close to now after hours being down to $52. Really all you need to be looking down here, obviously you have the earnings per share. We saw its revenue basically increasing, or the EPS increasing. We were finally able to basically get to a break even quarter, and then back to negative. We went minus 11 cents earnings per share, and now even worse off at negative 27 cents per share. So all things to be watching out for. Now, what are our key levels as we continue down? The key thing to note on Twilio is we did have this quick sell-off, but you'll see where we've slowed down and we're no longer crashing is our statistical mean on the 6-month chart. Again, this isn't uncommon. We don't actually have any after hours charts. Let me quickly throw this on just so we can see how it's reacting after hours. And we can see literally instantly flush down, and you get that pullback. Again, this common pattern, you tend to see this, but now we're continuing to flush down, and really we're kind of getting a lot more steady. We're slowing down, coming into that statistical mean. Again, likely or common to see, you expect usually a relief bounce coming into this level, so be watching out for that tomorrow. This isn't something I would do a gap and go trade on, so be watching out for that tomorrow. I know a lot of people like the gap and goes, something I do personally trade, but I don't trade it when you're coming into a key level, which we are on Twilio. So definitely be watching out for that. Could be, some fake outs if you're looking to trade the gap and go. But if we continue down, we have our next support at $24.50 and $19. So these would be the key supports we would be looking at. Obviously very far from where we are now, would require over a 50% sell-off from our after hours price. So longer term outlook, but if markets continue weak, which I mean, yesterday we had the Fed meet, or the Fed rate, we had the conference, and we had the statement. Statement came out quite dovish, but then it was all counteracted with the conference, which showed very hawkish. So if we continue hawkish, obviously stocks are heading down, and really in time we could see these kind of stocks which rely on a bit more debt, and you can see are doing negative earnings per share because it means they're more debt heavy. So the more hawkish the government is, or the Fed is, sorry, the more likely the stock is to fall. So again, if we break this kind of $50 support, I wouldn't be surprised to see in time a flush down to that 25. So be watching out for that. Again, if you're looking, depending on your outlook, whether you're a trader or investor, you'll be using these levels differently. I think it's more in a difficult area to start trading, just because we're coming in statistical mean. Again, we don't tend to open up positions in statistical mean because this is where we expect the stock to reverse to. We instead look to trade to it. So that's the only thing. At a position at $52 or so, it's kind of a difficult level to trade, or at least how I would trade it, a difficult level to trade. So for right now, I'm standing away from Twilio as a trading perspective, just because it's coming to a key level. You can't really trade the gap and go on it because a high probability that you'll get faked out. So instead it would be something I kind of wait for to sink down a bit more, and then if it's something I want to take on in the investment portfolio, $25 is going to be more key for me to do that. And again, that will also then, especially at the $19 level, provide way more trading opportunities. If we do quickly pop up though, we do have key resistances at $84 and $100. Now though, so these are the key longer term levels. These are the strongest levels that we will provide. But one thing I do want to quickly go over, just because these levels are so wide apart, is going on to a shorter term time frame, a 20-day on the left, and we will do a 30-day on the right, just to see if we have any levels. And we can see what we've actually done now is we are extremely oversold on both the 20-day and the 30-day chart. I mean, we expected this considering how much it sunk on earnings, but what this does really tell us is it wouldn't be unlikely to see a pullback tomorrow to at least $56. So again, when you're doing gap and go strategies, this is always, or at least something I like to do, I really like to be looking at where they are on the 20 and 30-day chart, because firstly, if they're on the 6-month and 1-year chart coming into a key level, I will usually avoid the gap and go. But one thing, and you can kind of use them in tangent, is if you're looking at the 20 and 30-day chart and you see they're past the third deviation, they're usually something safer. Again, not to gap and go, but instead wait for at least the pullback, because we expect as a minimum now a pullback to 33.56, and it wouldn't be unlikely to see a pullback all the way to $60 because again those are our third deviations, so really wouldn't be unlikely to see a pullback to at least 53, but again all the way to 60 again wouldn't be unlikely. So again, if you're looking to trade the gap, go be cautious. We wouldn't be unlikely to open up, start to push up, fill or kind of push back to these levels, retest it, and then if we are going to continue down, we will then do it from there. Anyway, that is the breakdown. I hope you enjoyed the video. If you did, why not drop a like and subscribe and check out one of these two analysis videos.